Hi, good morning. Good morning. Hope you can all hear me well. Thank you for joining the EOS webinar. Just a little introduction. I'm Emmanuel, Professor of Management and Governance at JCU Singapore Business School. And the EOS is a brand new research cluster where we're concerned about the consequences of the neglect of ethics by modern capitalism. So we look at capitalism as a fresh construct, and we look at how the neglect of ethics has impacted different aspects of society, from businesses to other stakeholders of, if you like, socioeconomic health and vitality. So that's the philosophical underpinning of this new research cluster. And we're interested in, if you like, a multidisciplinary scholarly research cluster with input from the usual suspects: accountability, business ethics, corporate social responsibility, but also philosophy, theology, finance, accounting, politics. And we look at the intersections of some of these disciplines and how they shape the concept of ethics and organizations within an increasingly complex society. So that's the idea behind this research center. And I'm very delighted to welcome you to its inaugural research webinar. And on that note, I would say this session is recorded, and it will be used by JCUS Business School for publicity purposes. I hope that's fine by attendees. If you've got questions during the presentation, by all means, make use of the question and answer platform, and we would go through the questions later on. So the presentation would be for about 35 to 40 minutes, and we would have about 15 minutes on the end for questions and answers, which I will chair towards or at the end of our speaker's presentation. So I would like to very delightfully welcome our speaker. Our speaker, anywhere, Sikochi, fondly called Siko, is an assistant professor and Bellow Corporation Fellow at Harvard Business School. At Harvard, he teaches financial reporting and control within the MBA curriculum. He's also a faculty affiliate to the Gender Initiative at Harvard Business School and the Center for African Studies at Harvard University. He earned his PhD in business administration at the Penn State Smale College of Business, where he currently serves also on the advisory board of the Center for Business Sustainability. He had previously had an MBA from the University of Virginia, Darden School of Business, and before his graduate studies, he was a consultant at Lexicon and Charles River Associate. He's a native of Zimbabwe, and he came to the United States to attend Midbury College, graduating with a major in economics and Russian. He's an alumnus of the United States Student Achievers Program, and he and his wife are parents of 4 children. Siko is a very good friend of mine. He's an extremely well-respected scholar, and I'm delighted to welcome you, Siko, to JCUS, and specifically to the Ethics Organization and Society Research Center at James Cook University, Singapore Business School. You have the floor now, Siko. Thank you.
Yeah, thank you so much, Emmanuel. You're very kind. I really appreciate the introduction. And welcome to everyone who is on the call. And I guess advanced greetings to those that will be watching this later on. So I am really excited to be in some ways kicking off this series. This is work that I think is really sort of important for us to be able to think about, sort of how organizations work from all aspects of it, right? So as you think of governance of it, ethics, and then the topic of corporate social responsibility is one that in some ways I think is going to occupy our endeavors and exploits in research for many years to come. So it has been my pleasure to work in this area. And so today, the title of the discussion or the presentation is, how do socially responsible firms respond to financial shocks? And so as a basis for this discussion, I'm going to be using a co-authored paper, which we are, for now, the title is Statutory. It's sort of in parentheses, and you sort of get to understand very soon why that is. So Statutory CSR and Firms' Response to Financial Shocks. And this is joint work with Serena Shirley from George Mason University, and she is also on this call. So for any questions and then comments that we're going to be having, she's going to be helping making sure that we document everything in some ways, also trying to document even the emotions that go into these into the discussions. And so again, I wanted to just sort of step back before I jump into what the paper is really about, but to go back to the idea of, sort of what is the motivating research question that sort of led us to again, it goes back to the title of the webinar for today, which is how do socially responsible firms respond to financial shocks? And so I guess it's a respond here, but I guess, so one of the things that we think of is, it seems like every 10 years or so, there's always going to be a big crisis. And these crises are coming, from a variety of reasons. So if we go back, maybe, so sort of to the recent past, we go back to the early 2000s. There was sort of the tech bubble. We had sort of the Enron issues that came up, and those really disrupted the way that the markets work, or at least the way we think of how markets should work. And so that sort of changed the way that investors were thinking, and so that also raises the question in terms of what type of companies are actually creating or contributing to some of these problems, and are all firms sort of responding to these issues the same way. And then obviously we sort of think of the big financial crisis in sort of recent memory here, which is the 2008 financial crisis, right? So in that crisis, again, I think one of the things, at least for us, as we're thinking of this topic is, there was a panic, right, in terms of the banking crisis. So the mortgage crisis sort of created so some serious financial issues in the capital markets. But I think what really sort of took the global economies to the brink of sort of failure, I guess, in some ways you could say they failed, is this idea that there was a banking crisis. The banking crisis arose because there was a rush, a lot of money out, and sort of the companies that were relying on these short-term loans, so those dried up, right? And so the question is, could firms have really responded in a different way? And in this day and age where we are talking about socially responsible firms, are there things that companies could have done, right, that could at least have helped or alleviate some of the issues? And as you sort of see from our discussion, we're going to be looking at how companies use their access to credit lines. And the reasons why we chose that, which I'll go into in greater detail later, is because if you go back to the 2008 crisis, sort of the banking crisis that happened, had many causes or sort of factors that led to it, but one of them was this bank run, so to speak, that a lot of companies actually took cash out to be able to prepare themselves for a crisis they didn't know when it was going to end. And so that's really where the question was: is did they take too much, which then contributed to the crisis? But before I sort of get there, I wanted again to take another step here and sort of, I guess it's almost like a reminder or perhaps just a quick review of something that most of you will be aware of, right? If you go back the last few years, we really have been talking a lot about stakeholder orientation for firms, right? So there is pressure from the investors, there's pressure from the communities, from policymakers, and also even from within the companies themselves, where employees may be demanding that the companies do better. Right, and then this is something that also was, at least starting in the United States, with all the social movement, the social justice issues, from racial sort of events that have taken place in the last several years, that they've really sort of forced companies to really think about what it means to be a socially responsible corporations. And so this led to back in 2019. So this, I think, followed right after George Floyd was sort of died at the hands of police in Minneapolis. That sort of companies, I think, it sort of saw a lot of these things coming together in terms of we have to do something. And there was this statement from the Business Roundtable, like a group of CEOs, about 180 of them, that committed that their corporations or their companies are actually going to focus on all the stakeholders, the customers, the employees, the suppliers, the communities, and of course, without forgetting the shareholders. Right. And so this, in some ways, so it's really sort of the culmination of all the push that it started way, way, way back, right, to say companies should focus on other stakeholders. But if we go to the research, right, so if we go to say, what is the evidence saying? Right, are companies actually living up to this idea of stakeholder orientation? The evidence that's coming out, so we sort of just looked at the last 2 years. So 2019 is when it came out, the Business Roundtable statement came out. And then we sort of look at the research that a lot of our colleagues in different areas of academic research have looked at. And it's not really, it's sort of in some ways showing that there is a lot of progress. That's not to say there is no progress. I think there is always progress. I think if you really look, there are lots of companies that are doing amazing things, and maybe it's just too early to sort of really sort of see where this is going. But for now, it seems that there is still this focus on the shareholder primacy, right? So which is the classic way that businesses have always operated, or at least have been thought to operate, right? So, for example, we have a listing here of a few research papers, right, from 2020, 2021. So some of these are still working papers, right? So, maybe the results may change, but at least they sort of give this evidence that, for example, with Bebchak at Talarita 2020, that the idea of accepting this stakeholder orientation, right, is not one that we should expect to produce material benefits for stakeholders. So this is in some ways a very skeptical look at what sort of stakeholder orientation is that, perhaps it's nice and it's well that we're talking about it, but we should not be expecting anything to come of it. And then if we look at some of the research that have come up, so if we go back go forward to Bay et al. In 2021, they're sort of suggesting that there is this disconnect, right, between the orientation towards CSR and the actual actions. Right? So if you look at what companies say, what we expect them to be doing versus what they actually do, right, we're not sort of seeing the results that we expect. And so some people have done this research where they're sort of talking about companies just doing the talk rather than walking the talk here, right? And so I think more directly related to that stakeholder orientation, the last paper that I have here on the slide, so the Raghunathan and Rajkapoor in 2021, and also Thomas et al. 2021, they really look at the proclamations towards stakeholder orientation, and they're saying that these are not really backed by hard data, right? So in some ways, this is, it's demoralizing, right? So we've had a lot of talk about what we should be doing. And so the question that we're sort of then asking in particular in this paper is sort of, why do we see some of these things happen? Right? We expect socially responsible firms to act a certain way, but they're not doing that, right? And so we then sort of ask the question, so why does this happen? Why does shareholder primacy persist? So we look at, so the two, in some ways, maybe conflicting theories, but perhaps complementary. But for now, there is on one hand, the stakeholder orientation, which is what we are pushing for. And then there is the shareholder primacy, which is what has sort of been happening and where the data seems to support is happening. And so as we're thinking about this, sort of we come up with this, sort of just, a discussion of what these two things mean, right? Number one, shareholder primacy. So this goes back to the beginning of times, right? And then obviously, recent memory is the Friedman in 1970, who sort of really put this in a way that we have sort of come to understand what business is about, which is that the company or the firms are there to maximize shareholder profits. That's what they do. And then you let the shareholders do whatever they want with their benefits. They may actually go and do charity work. They may do philanthropy, but the company or the business is supposed to just maximize the shareholder profits. And to back this up, right, that there are statute and rules and regulations put in place that give the shareholders the power or the right to sue the officers of the company if they believe that the officers of the company have taken actions that breach their fiduciary duty to the shareholders, right? So this shareholder primacy is backed in law. That if I do something that I think is good for other set of stakeholders, my shareholders may actually come and sue me for it. Right? And so for that reason, we think this is why a lot of the companies are actually going to be focusing on that, because there is sort of that legal aspect. And then if you look on the other side, which is sort of this idea of stakeholder orientation, right? So for the most part, when we think of corporate social responsibility engagement, right, which is this idea that you're going to be looking at the other stakeholders, it's a voluntary act. Right? Most of the things that you have to do are not required by law. There are some things that are required by law, but not everything. And even in countries where you are required to spend money on CSR, right, they don't tell you what you need to do. Right? It's just that you have to describe or to discuss what you have done or why you didn't do sort of anything to sort of meet some of these regulations. So this idea that this part of stakeholder orientation is something that is voluntary versus the shareholder primacy being something that is backed by law, that if you do not please me as a shareholder, I can come in, I can sue you, where there's actually some legal consequence. I think we sort of think that's where the friction is. That managers may want to do good, right, towards the stakeholder orientation, but then they also sort of this legal obligation that they have to work under. So we sort of take this and we say, so if we wanted to understand whether this really is one of the things that's driving the decisions, let's look at some of the things that have happened in the United States, for example, where states have created or enacted statutes. These statutes allow firms to consider other non-shareholder stakeholders, and if they do so, if the shareholders come and say, we didn't like what you did, those things were not to benefit us as shareholders, we're going to sue you, the managers of the companies can invoke these statutes, right? So in some ways there's some protection now. So there's a legal part for the shareholders, but now there's also a legal protection against these shareholder lawsuits for the managers. So if we think that, if really sort of this idea that the legal part is what's driving down the motivation or the desire or the ability to focus on the stakeholders, then when we introduce some of this legal intervention, we should see some moderation. Right? So this is where our research question actually comes in, where we're going to say, do these statutes moderate the shareholder focus or the shareholder primacy? And this here just gives you a map of what has happened in the US. So this is actually very prevalent. So if you look at all the red states right here, I guess it could be red, it could be brown, depending on sort of whether you're colorblind, like me. So there's about 35 states in the United States that have enacted some form of statute that say companies have the right and legal protection if they take actions that are not towards the shareholders. And then you still have some very, about 15 of these states, so some big states that have also said, yeah, for now, we sort of just leave CSR to the companies, right? There's no legal protection, so to speak. So that's sort of really what we are trying to sort of look at in this case, as we think about how our companies are responding to financial shocks, right? So if they respond in a way that we didn't expect, right, that causes problems to the financial markets, is it because there is something there that's sort of really stopping them, which is the shareholder protection? But what happens when we have this legal intervention here? So that sort of becomes our research setting, right? And to test this, again, going back to what I said earlier on, that one of the reasons why we think there was a banking crisis is because companies actually had a run on the banks, right? They took money than they should have, right? So this was obviously a part of it. It's not all of it. I think there were many things that happened back then. And so the paper that we rely on in this case is this Ivashina and Csrfs in 2010 in the Journal of Financial Economics. Right? So they really sort of look at that and they think that the companies that were vulnerable to credit line drawdowns. So this is a line of credit or a loan that has been negotiated with pre-terms, a set limit. So the companies have the right, but not the obligation, to take this money out, and they can actually use it at any time. And the bank has an obligation to provide some of this financing. So if there is a rush by everyone, or a dash by everyone to be able to get that cash out, that can actually lead to a panic. So that's sort of what we are sort of using here to sort of see, right? So how our company is going to respond. And so even though I'm discussing this from the context of the financial crisis, since we want to look at this from a CSR perspective, we sort of decided that we're going to look at the financial shock that comes at the onset of COVID-19, the pandemic. So we're really sort of in this, in this time here where we're grappling with the fact that the uncertainties that arise from COVID-19 for different businesses. And we also think that we have been talking a lot more about CSR over the last few years, right? So the onset of COVID-19 provides sort of this perfect timing to be able to say, okay, now really the issue of CSR is something that we're focusing on, is something that is, on the minds of almost everyone, right? So let's look at how companies now responded to this shock that came about. So that's sort of the research setting that we look at. And to just give you a quick sense of, what happens, right? Or what happened when there was the onset of COVID-19, a lot of companies, as one would expect, sort of rushed out to be able to get a lot of the cash out of this credit line so they can actually have that cash on hand in preparation for uncertainties, ambiguities that were coming up in the capital markets. And now when we look at sort of this pattern here that we're seeing in terms of sort of the big jump that happened at the beginning of Q1 in 2020, when countries were shutting things down, nobody really sort of knew what was going to happen. I think most of us, of course, had hoped, this was going to be just a 3-week thing or a 1-month thing. But as a business or as a corporation, you're starting to prepare yourself, right? What if this thing lasts for a long time? Do we have the resources to do that? And then this is where we say, is there any differential behavior here that we're going to observe in terms of what companies are doing when they're going out to take this cash out, right? And so we sort of separate this by 2, right? So this is really sort of gives you, a sense of, are socially responsible companies based on a measure of the CSR scores, right? Are those going to behave differently than other firms? Right, so here, I guess, so lo and behold, right, because we know that high CSR firms tend to have greater access to capital, right? So they actually go out, they seem to be the ones that are sort of taking out a lot of it, right? And so we can say, okay, this is something that we expect, right? They have access to capital, they're going to take it, right? And so then we say, yeah, but are they taking too much, right? So that's sort of the question that we're really interested in here, that, how do you respond to financial shock? Are you actually taking out too much because you can? Without sort of really thinking about that, if you take too much, even if you don't need it, you're actually going to cause the markets to even go into greater sort of distress, because there is now a rush on resources that are limited, especially from the banks that you are taking this cash from, right? And so here, so then our question, the main proposition we test is, some of this cash that companies are taking is not needed. They could have just left it out there. But the problem is, if they leave it out there and it turns out that this crisis, really prolongs, right? So now, if you did this because you're thinking about the economy as a whole to say, hey, let me take what I can, leave out for somebody else to use it, then the shareholders can come and sue you because you took actions that were not in the best interest or that did not maximize the shareholders. If that is the case, right, then we sort of are going to see that if we introduce these statutes that are going to protect the companies from these shareholder losses, then should we see an attenuation or a moderation in terms of the level that the high CSR companies are actually taking out versus the high CSR companies that are taking out if they don't have the statutes versus the CSR companies that have the statutes, right? And so if we see, just like what you see here on the graph that I'm showing you, that there's actually a change, right? So the high CSR firms in red, without the statutes, which are calling the non-shareholder constituency statute, they're still taking a lot of money up there, right? So because they don't have the sort of the protection of the law. But once we have this legal intervention, right? So the sort of the orange second line down there, right here, if you can see my mouse here, they actually are going to take much lower than the other high CSR firms. Right? So we are sort of saying now the legal intervention is actually giving the freedom to the firms to be able to actually, maybe just go out there and say, okay, we think there's going to be a crisis. We actually need to be able to at least shore up our liquidity position, but we don't have to overdo it, right? And if they don't overdo it, things turn out badly, they can actually invoke some of the statutes. And if things don't go badly, right, so they continue to have access, right? High CSR firms have been found or documented in previous research that they have access or better access to capital. So here, what you're looking at, I guess if I can sort of keep this for a few seconds, is really the main part of what we think is our contribution in understanding why companies continue to behave in ways that perhaps we, after all the talks that we've been having about stakeholder orientation, and they continue to behave this way, right? One, without any legal protection for the managers, right? That if they take actions that may later turn out to be bad, they could get sued. But if they can invoke some legal protection, right? Sort of our second orange line, which is sort of our main finding here, that you see some of that attenuation. And the low CSR firms sort of continue to take out less there. And there's also some separation, right, in terms of the companies in states with these non-shareholder constituency statutes and those that do not. And so here, as I'm showing you this graphical presentation, it's almost in sort of in the univariate. If I were to show you the regression here, you'd also see that the results are very sort of strong in differentiating between the high CSR firms in statute states versus the high CSR firms in non-statute states, sort of showing that some legal intervention is going to change the way we work. So you can see here, I've been sort of trying to repeat this in many different ways, but the bottom line is some legal intervention is going to perhaps change the way that companies actually behave. Right? And then, so the question that rises up or that may come up is this idea that, okay, so we expect companies to take cash because they don't know how long the crisis could be, and so that's just good business, right? And so we are saying that's good, right? Because every company needs to be able to have liquidity. But since we can see sort of that attenuation or that moderation, that means perhaps you don't need all of that. Right? And so one of the ways we can tell if that is the case is by looking at where is that cash going. Here, one of the things that we sort of look at is the cash actually going to be used? Let's sort of look at 1 quarter ahead. Right, 1 quarter after sort of this cash has been taken out, is it still sitting on the coffers, right? Is it still sitting, being sort of just cash holdings for these companies, right? Because that means they just took the cash to hold it, right? They're not really using it. That's not to say they're not using any of it, right? But we can sort of see that there is some association that happens with the cash balances. So here, and now I guess I can sort of show you some regressions or some regression results. So obviously, as we expect, right, after the onset of COVID-19, everybody went out to take cash, right? So in general, you can sort of see that, the very top line for COVID-19 here, we see sort of positive association, right? Positive association here, whether we use a continuous CSR score or an indicator for high versus low CSR. But then sort of the interesting part, at least what we are looking at, is one, what happens to the high CSR firms? Again, as we saw, the high CSR firms tend to take out a lot more than other firms. Then what happens when we bring in some of these non-constituency? Right? So one, we are sort of saying the CSR firms are taking out a lot more than everybody else. And then there's sort of some moderation that happens in terms of the balances in cash here, right? Which is sort of saying that, even though the results are not very strong, but there's going to be some mitigation in terms of how much cash is actually being held. But we do know that the CSR firms in general are holding more of this cash. So the idea that, everyone needs to take out the cash to prepare themselves for using that cash as they go forward, I think it's sort of saying some of this cash is just actually not immediately needed. It's something that they're just holding, right? And now the question is, are they holding incrementally more than everybody else? And that's sort of what the research here, or at least our results seem to suggest. And then another part could be, maybe they're taking this cash to, I guess one of the uses for it is, it could be employee growth. And so here I sort of wanted to write employee growth, but we actually don't have the results for it. I did tabulate them here to show you, because as some of you may be aware, the data for employees from CompuStat, from any other place, is very tricky to work with, because companies may report averages, they may report changes, and so it's really very hard to know what it means. But we can find that, if we were to show these results, there's really no difference between high CSR firms and low CSR firms. And if we look at payables, right? So one of the things that's important here is, are you paying your vendors? Because what happens, if I can sort of point you to the top line here, COVID-19. So at the onset of COVID-19, right, it looks like a lot of the companies sort of delay paying their vendors or their suppliers. And this is something that I think that tends to happen when there's a crisis. Companies tend to unlock their working capital by delaying payments to their suppliers. And in some cases, they're delaying up to 4 months, 5 months, right? So that gives them a runway to be able to use some of that cash to meet their other needs. And so that's something that we see here. At least sort of the results are suggesting that there was a decrease in the turnover, right? So how many times the suppliers are being paid. And now the question is, if the high CSR firms were taking out that cash so they can continue to pay their suppliers, we should see an incremental effect on the sort of that interaction, the COVID-19 and CSR firms. But, you know, so granted, there could be some data issues here, but at least for what we have done, we don't seem to find any of that difference, right? Which is to us suggesting that, you know, some of that money being taken out is not necessarily going to be used for some of these things that we would expect companies to do, right? To pay off their suppliers. They're just sort of keeping that money as cash, or they're holding the cash. Something that if we go back in time, back to 2008, we're saying that could have been one of the reasons we ended up in a banking panic. And now if we sort of say, you know, is there any change or moderation in some of the payables? We find maybe just, you know, within industry, so column 3, there is some moderation there that actually you find they pay more when they're in these non-constituent states, but overall, you know, it doesn't seem like there's any difference. So in other words, what we take away from this table is the way that companies behave, right? It doesn't seem to be different, right? Whether they're high CSR or low CSR, but we know that the way they behave in terms of treating other stakeholders, but we know that they're taking a lot more cash. We would have expected them to act differently for ICSR firms, but they're not doing some of that. And so again, this sort of raises sort of this discussion that perhaps we need to really talk about how, you know, CSR firms behave and how legal intervention is actually helping lower some of the cash that they're taking out of the banking system. That cash could go and help somebody else, right? That may need it. Like what tends to happen is the companies with access will get the cash, and companies without access will make it becomes even harder for them to access the capital markets. And that's something that I think sort of the discussion that we ought to be having, if we can sort of think about ways that, you know, we can avoid or maybe mitigate some of banking crises or panics that may happen or sort of happen again or take place again in the future. So that's sort of, you know, I think we're almost sort of at this 35-minute mark here. So I will go ahead and conclude, and then I'm looking forward to the discussion, the questions and comments that you all may have. And so here, so what we really sort of trying to do today is thinking about sort of, you know, what does it mean when we sort of step back and think about this pressure for stakeholder orientation, right? But yet we see that companies continue to prioritize the shareholders' interest. So what should we be talking about? You know, should we continue to, in some ways, try to just, you know, make so much noise and try to get the companies to act a certain way? But we thought, no, wait, let's sort of really sort of step back and say, what is, you know, the reason why companies may continue to do this? And we say one of these reasons is that companies have this fiduciary duty to their shareholders that is protected by law. They can actually get sued. So if there's a lot more legal intervention, if that becomes part of the discussion, are we going to see that the behavior that we expect from you know, corporate socially responsible companies is going to actually be different, right? So that's what we test here. So the proposition that this focus on shareholder primacy is actually going to be moderated or attenuated by these statutes that actually come up. And we find that actually is the case, right? That when we look at how socially responsible firms, as measured by sort of CSR scores, behave, right? So we expect them to sort of, you know, go out there and take out as much money as they may need to shore up or to sort of strengthen their liquidity position. Yet, when we look at now, when we introduce some legal intervention, sort of that dash or sort of that rush to get cash out actually gets to be reduced, or it gets to be much lower, which sort of to us suggests that, right, that, you know, in the way that companies may react sometimes, it is driven by where the legal positioning or the legal strength or sort of the legal power actually lies. And in the current environment, which is, you know, most of the US states, sort of the big states where you find a lot of the companies, sort of Delaware, California, and other places, and also just the world over, right? It's really about the shareholders. They actually have some legal power, but when we introduce some legal intervention there, that actually is going to change. So we think this is something that we sort of also should be thinking about. We've been talking a lot about, ESG disclosures, CSR disclosures. We've been talking a lot about companies should actually sort of become shareholder orientation, but we need to make sure they have the right tools to be able to do some of those things. So that's really sort of what we think. So thank you for taking the time to listen to this, and I'm looking forward to the discussion here. So I'm going to stop sharing my slide, but for those that may want to continue to connect at some point, I think if you can take your phone and sort of take that, or you can just go to LinkedIn directly and search me and connect. I've found some of my good friends and even collaborators on LinkedIn, so it's become a good place to connect. But bottom line, your thoughts even beyond this call here. So Emmanuel, I'll bring it back to you.
Thank you very much, Siko. What a wonderful presentation. I'm so happy with the way you started off, and particularly how you operationalized what CSR firms are and what CSR or CSIR firms are, because I think that's quite incredibly difficult in operationalizing them in your quantitative analysis. We have very interesting questions here, so I'm going to kick off with Abhishek's questions. Abhishek is our campus dean, and he has asked you how you would explain firm behavior in Singapore, where several firms returned government handouts that were given to them during the pandemic. So this is, if you like, a different context. We've looked at the US context, and you've talked about, the use of handouts in your particular case study. But we have a contrasting case here where you have firms that actually, handed back the handouts that were given to them. So how do you situate the shareholder primacy orientation in this different dichotomy?
Yeah, so that's a very good question. In fact, that's something that when we were sort of starting to think about this, the first time I presented it, so this when it was still just an idea, someone actually said, there is some support, right? That not everyone is actually going to be holding the cash. Right? So in some ways, I think what happened in Singapore could be, I guess, the way I would think about it is actually support this idea that companies don't always need all the cash they actually get when there's a crisis, right? But there is always this tendency, right, which I think is justified, right, that companies would actually want to get as much cash as they can get, right? And then the question is, are some of these companies going to think about whether they need this cash and sort of keep it, or are they going to say, you know what, we don't really need this cash, we're going to give it back? Because once you sort of give that cash back, it actually is going to create an opportunity for other entities that may not necessarily have had access to be able to get that cash. So in some ways, I think that's something that sort of is really in line with what we're thinking about here, is this idea that companies don't always need all the cash they get. I think in the US, for example, someone brought the idea that Harvard University, right, was eligible to get some of the PP loans. So those are the payment loans that were coming from the government, right? But I think obviously every organization was affected, right? So they sort of lost some revenues, but they could survive, right, without taking some of that cash. And so they decided also that they were not going to take it. But there were some companies that took the cash and only returned it after there was an outcry, right? So I think we have a few examples like that. So in some ways, we could actually use some of these as specific examples. We could even put them in terms of, could we consider these high CSR firms, or, the ones that returned it, why did they return it? Is it because they just thought, hey, we don't need it? Or is it because someone else actually said, you don't need it? And so our proposition, or at least our hypothesis, would be for companies that truly are socially responsible, right? That they understand that, their actions in the capital markets are actually going to contribute to further financial contagion or further disruptions in the market, may decide to say, you know what, let's sort of, just keep what we need and bring back some of that cash. And in fact, I think that's sort of one of the things that we hoped to see, right? Which is that, companies will sort of know, I guess, we can go back in sort of some of the classical economic theories, right? I think we understand the idea of bank runs, right? I think, the bank runs have been happening for many years over, right? I think even, people that are not in economics that like to watch movies, right? I think you might have watched It's a Wonderful Life. There is a story in there about, a bank run. I think there's also, I'm forgetting the name of the movie here, but the lady, the nanny who does magic, I can't even remember now. My kids will not be happy with me. There's a bank run in that thing. So this idea of bank runs is almost like, everybody should understand it. So our thinking, or at least the way I think of this, is managers know that their actions have consequences. If they take out cash that they're going to sit on, they have actually created pressure on the capital markets. Right? So with that assumption, then the way that companies use cash is something that they should have some discussion in their boardrooms. They should have some discussion in their management sessions about, what is our action going to do to the community, right? If they're thinking about stakeholder orientation.
Thank you very much, Siko. I think you're right, because there could also be some stakeholder pressure for companies to return that handout, which can create a further legitimacy issue for other firms to follow suit, even though there's a reputational advantage. Thank you very much for that. There's another question here. When discussing stakeholder-oriented firms, have you noted the difference between internal stakeholders, that is people working within the organization, and external stakeholders, people outside of the organization who may still have a stake in the firm? So I think this is around stakeholder distance and these internal and external stakeholders, whether the way you operationalize the variables, you looked at this extension, whether there's a difference there.
So I guess maybe the simple answer is we did look at it, but perhaps not jointly, right? Because so when we think of the external stakeholders, right, we think of maybe suppliers. Right? So suppliers, we sort of consider them as external. So we look at, how are the suppliers, being treated when there's a crisis? Yeah. So we expect companies to pay their suppliers on time. In fact, one of the reasons why a lot of smaller companies may fail is because the big companies or other companies are just not paying them, right? I think in Europe, there are now rules and regulations and laws actually saying you have to pay. If you don't pay by a certain time, you have to disclose and explain and all those things. So that's put pressure on companies to pay their suppliers. So we think of suppliers as a very important external sort of stakeholder here. And so we look at, what's changing there. Right? And then we also considered employees, in which are sort of internal, right, stakeholders to the company. So we did some things there. Again, as I said, we didn't tabulate the data because we don't find that there's any difference, but we don't know if it's because the data is just bad or if there's no difference. So I think we always consider sort of bringing it up there. But if someone actually, has ideas in terms of how to do with employees, that's something that we sort of try to do it. But again, we do think about it. So when I say we don't do, we sort of, it's yes, but maybe perhaps not. We don't do it jointly. So we are not going to sort of look at all the different external stakeholders, internal stakeholders, and sort of see all the different trade-offs that the company is making. Because I think it's easy to do one at a time, but we have to consider that in practice, companies are making decisions for each and every stakeholder, right? They have to make trade-offs. If they have just a limited amount of resources, they may choose to pay their employees, they may choose to pay their suppliers, because if you miss one or the other, right, there are always going to be repercussions, right? If you don't pay your employees, they may decide not to work. If you don't pay your suppliers, then you may run out of the inventory that you need to be able to continue to run your business. You need to pay your administrative expenses. There are many other things that you have to do. So we do consider that's just, we think, at a minimum, we need to at least sort of see how are you treating some of these stakeholders. But, to the extent that we can find a way to sort of really look at this, or maybe that could be for future research, for someone else to really say, what are the trade-offs? Like, what are they really doing? Right? We may observe one thing, but behind the scenes, many things are actually taking place.
Thank you. I think it's a good reference to Europe, particularly in the UK. We have the prompt payment code, and I think recently during COVID, the government has overhauled that again to ensure that large businesses pay their suppliers on time. At the moment, there's a 60-day target that large businesses have to comply with for, I think it's 95% of their invoices, and that, about 3,000 companies that have signed the code. But nonetheless, the problem is still rife. I wonder what you think of the US taking a stand on such in terms of legislation or some other soft regulation. But in addition to answering that, there's a question here about other forms of, if you like, lifelines for the business. So credit line aside, what are some common approaches that companies can use to cut cost / generate revenue in order to remain afloat? So if you can take those two questions, go. Thanks.
Yeah. So I guess, this idea of trade credits, one of my paper that we worked on about 2 years ago, right? So the motivation was this very issue that, especially in the US and even, before Europe also sort of went towards this idea of regulating or requiring that stakeholders be paid. We found that many stories, right, going back to in time where lots of companies were either deciding to move away from big customers, sort of losing revenue because they were not being paid on time. So sort of smaller businesses would rather lose business and sort of at least make a little money than they have these big customers that were not even paying them. Because some of them, I think Black & Decker, for example, was one that was cited that in 1 year, their working capital of over $500 million was driven primarily from not paying their suppliers, right? And so I think in some ways, I think the US tend to be slow in regulating some of the ways that corporations act. I think there are many things. I think even ESG, right? So we think of environmental, social governance regulation. I think we're always playing catch up to Europe. I think Europe is sort of mostly, I had in thinking about some of these things. So I hope it's something that people are talking about, at least from the regulatory perspective. How do we protect especially the smaller businesses? I think the bigger companies may have access. So I guess maybe to the second part of the question, which is how do companies actually get to be able to deal with liquidity? Right? There's several ways, right? One, which is sort of the dark side, right, is you just don't pay your suppliers, or you delay them, right? So that's one technique, which is, I guess there's a newspaper article that called it the dark side of American corporations, which is that idea, most of how they make their money is by not paying their vendors, right? And in some of the work that from teaching, right, if you look at Tesla has been sued by several of their suppliers, right? So there's always a litigation with suppliers because they're not being paid on time, right? So it's a big company, we respect them because they're an electric, high CSR from that perspective. But then we look at other perspectives, right? Which is sort of, hey, are you paying your suppliers on time? It becomes a technique or a strategy for most companies to actually, create some working capital. But it's a darker side of corporations because it's benefiting the shareholders of the company that's not paying, but it's destroying the shareholders of the company that are not being paid. And it's also, can lead to unemployment, like many other things that could happen from that. So that's a discussion that I think is important, or at least worth looking at, what's actually happening, how are things happening. So I haven't followed up in the last year or two actually to sort of see if there's been any movement in the US or other places since I sort of last wrote that paper, but I guess maybe that's a reminder to do that. And then another source of capital is just going out and borrowing from banks, right? So they sort of the banking, so some companies have access to banking, which is new loans, right? What we are talking about in sort of in this discussion that I just presented is so this is credit that you've already signed the contract, you have access to, but then you can also go out and create borrow from either banks. You can also, for other companies, they can do corporate debt, where you have bonds, public bonds being issued. And then, some companies also just decide to really sort of make their operations efficient, right? And, this is also, again, where another stakeholder may suffer, which is the employees, right? One thing that happens is when there's a crisis, companies will just go on and do sort of, they will in some way sort of, eliminate positions. They will terminate positions, actually allow them to save money. And some companies maybe would be more generous by asking people that are towards or closer to retirement to be able to retire. And I think that we saw a lot of that happen during the COVID-19, where, because I think it sort of removes certain expenses from the company. They may have to pay some, severance packages and all those things, but there's some day-to-day expenses that are actually taken out, and that allows the company to free up some capital. And some companies may just delay innovations, right? So if you're a company that needs to always be innovating, maybe you sort of wait a year or two to do certain things because you're sort of preserving or conserving the cash that you have here. So there's several ways that companies can actually do management of their working capital. Maybe one more thing to sort of just point out is, if you follow what's happening with the audit companies like EY, Deloitte, so they actually recorded a lot, it's very strong financial results in a decade, just within the last 2 or 3 years. Right. And when you look at sort of what's driving that, again, there's sort of been a newspaper article that came out over the last few weeks. When you look at what's happening or driving some of these results is these advisory services. Right. And so one of those advisory services is working capital management, right? Because companies are realizing that, we are really under pressure. We have to manage our liquidity. What can we do? How do we balance out the inventory? When do we buy it? When do we pay? When do we get paid by our and so these accounting firms have really, created these very strong working capital advisory teams that help companies manage some of these, just to sort of underline the importance of managing cash and being able to consider all the different ways that you can actually do that.
Great, thank you very much for the answer to that. And there's a lot in the accounting literature about working capital management of short-term liquidity.
Mm-hmm.
So many ratios that could help you with managing your receivables, your day sales and receivables, your inventory and turnover, and some of these things. So if I can go to the next question, I think this is a very interesting question, which hopefully builds upon on your idea about statutory CSR. And there's a paper we wrote, published in the Journal of Business Ethics. I think it's playing with a similar idea with you, Siko. We called it obligated CSR, which we sort of defined that as the barest minimum that firms should do, which is do not create harm to other stakeholders. Essentially, you don't have to do good for all stakeholders. You can stick with shareholder primacy, but in the process of sticking with shareholder primacy, do not create harm. So that's just a very simple way that we operationalized it. But this question is about legal frameworks change and saying that can be a moderator for companies focus on whether stakeholders or shareholders. So what are the chances that government will change the legal framework that currently favors shareholders? So would we have essentially a different capitalist system that has a legal background that is more stakeholder oriented than shareholder oriented?
Yes, so I guess in some ways, right, again, that's a really interesting discussion to have, right, to think about, should that change? So, in the US, right, so I think this discussion goes as far back as, I guess, so the first person that is maybe credited for this goes back to 1984. Freeman, right? So there's Friedman back in 1970 who says the shareholder primacy, and then there've been a lot of discussions after sort of that 1970 piece, because it was an academic piece, but I think it was also in the New York Times, so right? So it was something that was popularized, and so there were lots of discussions back and forth, and then in 1984, Ed Freeman, Virginia now, he wrote the book, right? So the Stakeholder Theory. And so he sort of, started to compile all the things that have been coming out of the discussions, and sort of said, we need to be thinking about other stakeholders. And so in that time, states in the United States, right, so we're also starting to have some of those discussions, right, for various reasons. And this is what led to the enactment of these non-shareholder constituency statutes. Right, it was the realization that if you let companies just do the things that they do, right, they're going to focus mostly on the shareholders. But you need to be able to infuse sort of some of the incentives to be able to do that. So I guess in some ways, so these states give, it's like a blueprint to say it can happen, right? Where the governments, and in this case, local governments, will come in and actually say, we ought to be doing something more than just for the shareholders. But maybe the question here is, can that happen at the national level, right? I don't know. I doubt it. It may happen, but I think it would be, because then it becomes a very serious political issue. But I think that's why it has happened at the state level. There are some states that I think are known for being, business friendly, and there's some states that are known for being, sort of community friendly, so to speak, right? And I think so if it serves the purpose of the state, I think that's where you sort of see that these statutes are coming into place. But I think there's just so much that's happening at the federal level that this is something that if it happens, I don't think it will happen anytime soon, right? Because for example, now, sorry, what's that? Go on. Yeah. And then so if you go outside of the the US, right, we think of what could happen in other countries. So I think they will be maybe sort of targeted regulation, right? For example, I think the one that I always go back to, of course, because I've done work in trade credit, is protecting the small and medium enterprises, right? So what's happening in the UK, right? So what's happening there? So I think so that's sort of just say let's focus on one stakeholder and say, what can we do to be able to make sure we actually support that stakeholder? And so I think, the good thing about that is, you don't have to mandate all the social issues because there's just so many, right? We can't do that. But by at least protecting, especially the small and medium enterprises, that is actually going to ensure that there is, sort of a trickle down, right? If we think of economic development, because if we make sure that all the small and medium enterprises succeed, right, they provide a lot of employment, right? And if we have a lot of employment in the community, then there's sort of economic development. So we, in some ways, have also mandated social issues because now people get work, people get to go to school and all these other things that may happen. But if businesses are failing because they're not being paid, then there's a problem. So I think, there's going to be targeted regulation for specific stakeholders that are easy to think about, but, sort of a more blanket regulation to say, let's protect all the stakeholders. I think, that's hard to do. Right? Because even the ones in the US, the ones we use, right, it's not always that all of them are actually saying, people are doing everything, or that you can actually be protected by saying, I did this because I wanted to protect the community. I did this because I wanted to do to protect the, maybe suppliers or customers. I think you can still be taken to court, right? And there's an adjudication that happens to sort of make sure that you're not just doing things again to hide behind these statutes.
Great, thank you very much, Siko. In the interest of time, I'll take just one more question, but I'll take three more questions. All right. So on page 11, I suppose that meant slide 11. There seems to be two spikes for ICSR firms with these statutes. Is it possible that these firms actually utilized their cash gradually, that is not one at a time? You may want to look at the accounts payable, that is your dependent variable, 2 or 3 quarters later. So I don't know what your quick feedback on that is.
Very good point, right? Because again, different companies have different time windows, right? So we are looking at this on a quarterly basis, right? So maybe a big chunk of their expenses will come in Q3 or Q4. So we have looked at Q1, we have looked at Q2. I don't think we looked at, sort of what happens after that. But, again, that's something that we can easily, we can definitely do that. But it's valid, right? To say different companies are going to actually do things very differently. And one other thing that you can also see from those graphs is, if you look at the change in what they end up borrowing in the future, right? So if they borrow a lot in one quarter, then we should expect that, in the future, right, there's almost zero in terms of how much they're borrowing, because it's saying, hey, we've already borrowed there, right? So we don't need any more cash, right? And so we just, now we should only be looking at uses rather than sources of cash, because there was one quarter where you build up that cash, and then going forward, we should be seeing some uses there. But right now you can still sort of see that it goes down go back to what it was pre-pandemic onset, right? And then so you can go forward. But for now, they the use or sort of some of this for the suppliers, for example, it sort of reverts back to what it was, when you go to the third quarter. But at least we've looked at the second and so it's Q1 after the first one. So we've looked at 3 quarters after the onset of COVID-19, right? So which is what we're calling Q1 and Q2, or T1 and T2. It's actually the T is when the COVID happens, when you borrow, and then we look at the quarter after that, and then the quarter after that. So it's almost like we are looking at this 3-quarter window since the onset of COVID. But yeah, so things tend to go back to normal once people start to realize that, hey, this crisis, we have sort of figured out what this crisis is about.
Thank you very much. And there's 3 questions in these, I think mainly around your methodology and application. So do the results apply to the subprime crisis in 2008? Also, is ESG used in this paper? And third, do the credit lines used in your paper measure the utilized credit lines or the limits of credit lines?
Good, very good points. So the first one is the mortgage crisis. We didn't look at that, right? In terms of, I guess I'm sort of, but we sort of used the 2008 as a motivation, and as we were looking, so we actually, I guess in some ways we sort of ran a regression to say let's just look at all the different crises, right? And so we different crises, you're going to see some jumps. So if you look, if I'd shown you that graph going all the way back to 2000, right? So there's different, there's a different magnitude in terms of how big the jump is of how much money is taken out, right? And then also, the reason I guess I said we chose the most recent is because that's where we think there's a lot more focus and discussion around CSR, but we could have done the same going back. And so I think maybe one thing that is useful is to just sort of either have some robustness, once we talk about the paper, that sort of says, let's just look at all these major crises that have happened, right? Sort of what has been happening there as well. So the initial work that we've done suggests that we are going to sort of see the same things, but we didn't do a lot of robustness for the crisis before the COVID-19. And then the second question, so what was the ESG part? Just the way it's measured?
Is ESG used in this paper?
So I guess ESG and CSR, we are using it interchangeably, right? So I guess, the way we think of, CSR as corporate social responsibility, and then sort of ESG, sort of environmental, social and governance issues, but the way that we are measuring it, right? We are proxying the engagement in CSR by the ESG scores, right? So these are, we actually use Thomson Reuters, the asset for, right? Which is sort of saying that they can go out and make an assessment of the engagement that the company has with its, on its social theme, and also when you think about its environmental pillar and the governance part, right? And obviously there, I guess one of my work from last year in the accounting review, sort of brings this issue that we can never really know what these ESG scores mean. Because if you look at one rating agency, they give you one score because they're focusing on one thing. You look at another rating agency, there's going to be something else. There's going to be some of this disagreement, right? And so we choose to use, at least for the main part where you're saying, let's have a discussion about how companies behave. So let's just take these CSR scores as given from Thomson Reuters, which is one of the bigger one, right? And say, if that proxies, or at least it correlates with the performance of a company, is that something that's going to inform the way that they behave. But again, I think, more things that needs to happen then is to say, what's really the best way to capture a company that we call good CSR, right? Because maybe what these results are reflecting is perhaps these companies that we're calling high CSR are not really high CSR companies, right? It's just that they're being rated that way. But if we were to really sort of go to a point where we say, we have a way to capture companies that are really socially responsible, right? And then we say how they behave, and other companies that are not. So, I think that's a very important discussion to have. We, at least for now, I think it's still very hard for people to really know how to capture that. And then for the last question,
how do credit lines used in your paper measure the utility lines? Or,
yeah. So,
yeah.
Yeah, so right now we use how much money has been drawn down, right? And so what we are essentially saying is there is off balance sheet, right? So that there's an amount of money that you've agreed on that you can take out. So that's sort of the total credit lines. And then there's an amount of money that you draw down, right? So you're going to the bank and you say, I want to collect on the promise you've made that I can take out cash anytime. That's the part we are focusing on. And then the other part, which I think we could also then be using. So I guess if you talk about the terminology that banks use, so utilization means you've actually gone to the bank and you've taken out the cash, right? But I think if we were to just sort of talk about it more literally, utilization actually could mean that you have taken that cash from the bank and you've actually used it somewhere. Right? So that part is what we were trying to capture with the cash part, right? To say, is that cash being used? You take out the cash. Is it being used, or is it sitting in your on your balance sheet as cash? Or are you using it to pay your suppliers? So that's where we're trying to capture this utilization within the firm. But on the contracting terminology, the utilization, that's sort of what we're really capturing in a way, that you've taken out this money from the bank, right? From the bank's perspective, you've utilized your line of credit. But I don't know if that's sort of, if the question was talking about that first one or the second one. But just for clarification, we are capturing the amount that has been drawn down from the credit lines. And then we try to proxy for what the company actually uses. Because I think that's really the most important part of this discussion is, are companies taking the cash to use because they want to use it, because they need it, or are they just taking out the cash because they just want to sit on it, right? I think, if we can nail that down, I think the discussion is really going to be richer right there. And again, if there are thoughts or if people have other things that they can think of, that's one place I think we can actually use help to make sure that this discussion, becomes something that we can think about, whether this is just wasteful borrowing or if this is really productive borrowing. And so what we want to advocate is productive borrowing, right? If you're going to borrow money and create economic activity, right, that's good. If you're going to borrow money, sit on it, and somebody else who could have created economic activity has no money, that's bad.
Thank you. Thank you very much, Siko. I'm going to ask a very final question. We're 10 minutes overrun now, which I think points to how interesting your work is. In terms of theory, reading your paper, you moved a lot in between shareholder theory, stakeholder theory. And I'm wondering, and I'm just thinking about what your potential theoretical contribution would be. So the first question is, what is the theory of this paper, if there is? And second question is, what would be your theoretical contribution? What theoretical contribution would you be working towards?
Interesting. Yeah. So I guess the way we, I'm trying to sort of think of if we'd actually use language that sort of tries to get to what you're alluding to here. But I can't think of specific language. But maybe let's sort of I can walk you through at least the theory that we use. So in some ways, we are saying there is a theory of the firm, right? How the firm operates. Right? So again, this is sort of different from the Jensen and Menkling, right? But as we're sort of thinking about, the way that a company is going to make decisions, right? So we sort of based on what has already been brought up there, we think a company's decisions towards CSR or it is towards its operation, those decisions are driven by sort of two, somewhat conflicting, but in some ways sort of related theories, right? So on one hand, we have this sort of shareholder primacy, which says the company is there to create value for its shareholders. But then on the other hand, there's sort of this stakeholder theory, which says the company should be there to meet the interest or the needs of all its stakeholders. Right? And so if you think of that, I mean, it actually makes sense for a company, right? Because if you make your employees, right, you're going to be a good company. If you make your customers happy, they're going to come back. You make your suppliers happy, they're going to continue to supply you. You make the community happy, you have the license to operate, because the community can make things hard for you as a company or as a corporation if the corporation is not actually meeting the needs of us. So that's sort of really, we're relying on those theories that have already been developed. And so where our contribution is how do these things actually relate to one another? right? So we think that the shareholder primacy tends to dominate, right, for companies, because managers are thinking about, I've been employed by the shareholders, right? And if these shareholders can fire me, they can sue me. And it's that legal part that I think sort of drives some of these decisions. And so we then think that if you were to then introduce, right, so this legal part, or sort of have a legal intervention in the ways that companies approach stakeholder theory, right? So in some ways, what we are saying, I guess maybe our contribution is, there's shareholder primacy and there's a legal part that backs that up, right? So your duty is to the shareholders. If you don't do that, they can sue you. But then we are saying, on the other hand, your duty is to all the stakeholders. And then the question is, is there a legal part that supports that you do that? So it's almost like a counter legal argument, which says, instead of the other stakeholders suing you, we are saying, if this other part of the shareholders sue you, you can be protected. You can invoke this legal part. So we're sort of trying to say, if we can add this part here, the legal part, to the stakeholder theory, we can see that companies will actually behave a certain way. So maybe I may have to think about articulating that as a theory, but that we were thinking of it in terms of just.
I think that is super clearer now. What you're probably trying to do is a legal framing of stakeholder theory. So it could be because there are two ways to look at it. You can look at it from a reflexive governance type of framework, right? And that's in legal theory and law papers. But there's also a lot of work around instrumental stakeholder theory and strategic CSR, which in a way plays with the same logic from an economics type literature, right? But I think what you're probably trying to get at is that legal backing, legal framing to advance stakeholder theory. And I think that might be where that theoretical contribution lies. So thank you very much, Siko. We've really enjoyed this very thrilling presentation. And I want to thank you.
My pleasure. Thank you so much.
I think, are you in Boston?
So actually, I am sitting in Zimbabwe right now.
Zimbabwe, yes. So the time is not too bad for you then.
Yeah, so it's only 11 a.m. But I have my collaborator Serena, on the other hand, is sitting in Virginia, so she had to wake up at 4 a.m.
Oh, thank you very much, Virginia, if you're there. So thank you very much, Siko. Thank you very much, attendees. Please take your time to complete a satisfaction poll, and I welcome you to participate in further seminars by the EOS Research Cluster. If you're a PhD student, you're an early career academic, you are a more experienced academic, by all means get in touch with me. I'm happy to discuss further how you can collaborate with the Ethics Organization and Society Research Cluster. So thank you very much, everyone. Thank you, Siko, once again. Thank you, Vinay. Thank you, Erica, for putting all of these together and the organization of it. Thank you, Louis, as well. And good luck, everyone. I'll see you another time. Thank you. Bye-bye. Bye, Siko.